Hello, and welcome to Chapter 4 in our Federal Individual Tax course with your host, Professor Naragon. Now, Chapter 4 is bringing us more income-based items we can use, especially related to capital gains, so sales of stocks, if you want to look at it that way, and real estate, passive income. We're going to be dealing more with that with this chapter. We're also going to look at the Qualified Business Income Deduction, which is a new law that just started this year. So, more fun stuff coming to us. So with that being said, there is a few items that you do have to kind of learn that you're going to get. It is missing one, according to this one, but basically that's just describing the actual capital gains and how tax works. So we do need to define what a capital asset is, apply and holding periods for long-term and short-term capital gains, calculate gain and loss on those assets, compute tax on capital gains. Again, we're going to describe a little bit of these items as we go. We're going to apply the exclusion of gain from personal residence sales, and then tax rules when it comes to rental and vacation, treatment of passive income / losses, and describe basic tax treatment for deductions for net operating loss. And then last, we're going to deal with qualified business income deduction. So let's start off. What is a capital asset? Basically, a capital asset is not really truly defined in a way, but it really is any assets that are other than inventory, receivables, copyrights, government publications, real property used in a trade or business that actually gets sold a different way. And then our new law, the TCJA, included patents, inventions, modeling, designs, or a secret formula process. Really, a capital asset is any asset that we actually buy for our investment purposes to sell at a later date, okay? And we sell it for either a loss or a gain. So this does include stocks, houses, boats, cars, companies, anything we sell for investment. These are going to pop up on what is known as Schedule D, which I will show you an example from your book what the Schedule D looks like. Okay, so holding periods. This is actually pretty much the easy thing. This really does help determine tax treatment, long-term versus short-term. Short-term is going to be known as ordinary tax. It's paid basically if you got any income, like your regular tax bracket. Long-term has something known as capital tax, okay? And it's going to be taxed a little bit different, and that really depends on your tax bracket itself, how much income you have. Most are going to fall probably between about 12%, but usually if you're under like 36,000, a little bit more with married filing jointly, you get no tax. It's awesome right there. So long term is really anything that's held for more than 12 months. It's got to be held for more than a year. Short term is just the opposite. It's what's held for less than a year. And we really want to basically first always figure out our holding period. Usually this happens a lot more with stocks than investments in land and houses. We usually hold on to those for a little bit longer. But again, if you do flip it in a short period, you'll be under short term. So when we're looking at capital gains and losses, we're looking at the sell or exchange. And usually the sell or exchange of a capital gain is going to be defined basically, what did we buy the item for? What do we buy the item for minus basically any expense, well, any sale of it, so the sell receipt. But we also get to add on any expenses if it happens to be a physical asset. So houses, we can add on property tax, we can add on repairs and maintenance, that stuff if we're selling an investment house. With stocks, basically we just get what the stocks are. So we basically take what our cost was and subtract it from the sale. This is how we figure out our actual gain or loss. Either the sale was more than what we bought it for, or it's going to be less than what we bought it for. Okay? And capital gains and losses really do receive that special tax treatment. Capital gains basically are long term, because that's usually what capital gains are, is long term. They do get the whole little different benefits, and we have to watch out. And see, again, they're talking about tax treatment right here based on the length of time property has been owned. Again, capital gains is really only with long term. Short term, it's usually being taxed at ordinary rate, so there's not too much of an actual capital gains being done. Okay? So here's our formula again to basically on realized versus recognized. Okay. So again, realized is our basic, the amount that we realized, the amount that we sold it for, minus the adjusted base of the property. Again, this is when we're selling real estate, cars, physical property. We can actually have that adjustable base. So this again could be sales tax, it could be any commissions if it's a house, all those other expenses we have to pay for increase the basis in the property due to the fact that these are added expenses that cost us to get the property. Okay. Realize, once you subtract, this is known as realized gain. This is the gain I can actually realize. And then you can have a gain deferral. These gain deferrals are mostly, sometimes we can defer the gain, especially if we took what we got and basically exchange it for something of the same product. And this is like a 1031, basically like kind exchange. So they do briefly bring this in, and we do have to deal with this every now and then. Stock sales, doesn't happen. They're still whatever they are. But again, with other physical assets, property is the big one. Okay. If we are allowed to defer the gain and it doesn't cover the whole realized gain, that is an actual recognized gain. Most of the time we don't have a deferral and we just go from realized gain, and it actually is also recognized gain. It's what we recognize as going to be on the tax return. Okay. So the amount realized again is gross sales price minus whatever transfer cost. The gross sales price in itself is the amount received by the seller from the buyer. Okay. And it's going to equal either cash and fair market value plus probably liability assumed. So again, anything the seller has to buy that really the buyer doesn't cost, and then cost to transfer the property. So all these can be in the sales price. Best thing I would always say, look up an example of a HUD statement if you never bought a house. If you bought a house, look at your HUD statement. You're going to see buyer and seller. There's certain things that increase the sales price for the seller, and there's certain things that decrease for the buyer. That's a good example to actually see what's happening with a sales price that changes. Okay, so with this, the adjustable base, again, this is going back to what I've already explained, but a little bit more, a little formula form. Adjustment base, again, starts with your original cost. Okay, this is, if this is property, again, this is more for investment property. You have the original cost, which again includes settlement fees, closing costs, anything that's really part of that original cost. Then it's going to take any capital improvements that you've done, basically any repairs, anything that's basically improved the value of the property that we have not depreciated out or anything like that. And then any accumulated depreciation, if we've actually depreciated this property based on rental, we subtract that out, and that is now our adjusted base. So this is more if you've had 2301 or 2302. This is dealing all with depreciation. Okay, how do we come up with that adjustable base? What is it worth? Okay, so settlement and closing costs, if you don't know what they are, this is a good slide right here. This basically includes charges for installing utility services, legal fees, recording for survey fees and transfer tax, the title insurance, and any amounts the seller agrees to pay. Any of those can adjust at closing costs. What doesn't count are basically not an adjustable base. It is escrow for future payments / taxes, utility charges related to occupancy, rent for occupancy. Basically, you can't charge any income. It doesn't work. Charges connected with getting a loan. Does not work there either. Okay. Now, commissions go with closing costs. So that's part of that. That's part of the legal fees, a lot of people will say. But that's also something that will actually be part of closing costs if you had to pay that. Okay? So that's a good basis. Again, that goes with the original cost. So this is good to actually know this stuff. Again, if you look at a HUD statement, you're going to see these listed. And that will definitely tell you what's added and what's not. Okay? Here, cost basis for stock. Alright. This is actually a little bit easier going on. So, even though it says oftentimes difficult for taxpayers to track adjustment basis of stock, we really just look at the 1099-B that we get. To be honest, we have stock providers actually provide this information to us as tax accounts. It's part of the IRS documentation. So, first off, it will depend upon when the stock was purchased. So you may have a short-term gain, you may have a long-term gain, and also the date is also when it's inherited or received as a gift. Now, when we sell it, again, we usually sell it through a stockbroker or a stock exchange. They keep track of it, and they will know the basis of your stock, or at least how much you bought it for and how much you sell it for. We actually just take the difference, and there you go. Just have to remember, is it long-term or short-term? Okay. The basis depends upon how acquired. Okay. So, when we actually buy the stock ourselves, that's its basis. There we go. If it happens to be inherited, its base is on fair market value. That's what FMV is at the time of the death. Okay, so it's not how your grandparent, if you got from your grandparent, how much they bought for. It's based on the fair market value. So the value will change when it transfers to you. Usually, it's always based on when you receive it. Okay, gifts are a little bit different. Basis depends upon whether Donnie sells at a gain or loss. Okay, so basically when we're dealing with a gift on stock exchange and stocks, the Donnie, which is us, really does affect the basis. Again, mostly when we're looking at the basis, it's usually when we receive it, okay? But with gifts, sometimes this one will go still with how much the donor actually paid for it. So gifts are mostly the one that's a big confusing one. I will say that. It usually runs, we don't usually see gifts of stocks anymore. They usually get inherited. So we're not going to get heavily involved. It's always good to know. And I know your book. So right here in your book, we'll explain it just a little bit. So let's see if we can find it real quick. So again, a lot of this cool little stuff. So long-term capital gains, it's usually 0, 15, or 20% depending on. And then there's uncaptured, the 1250 gain that will come in chapter 8. So we're really going to talk more about that, and that is capped. And then collectible gains, they're capped at 28%. So collectible actually does have its own tax. Ooh. So here they are. Here's the rates. So we love this. So when we're looking at long-term capital gains, again, it's all about your income level. Okay, married and filing jointly, getting $77,200, you have no tax. Up to $479, big range there, 15%. So most of us we're going to fall under a 15% rule. Okay, single, same thing, up to $38,600, no tax. Up to $425,800, 15%. Head of household, again, they get up to $51,700, no tax. After that, it's $452,000. Okay, so they all have their own little limits, and it's always good to know this. Okay, that actually helps out a lot when it comes to those. Just want to see if the book has anything about stock. Calculation. Okay, this is our calculation of gains. Alright. And more calculations. I mean the PowerPoint's a little bit easier to run through, but when you do it, look for it in the book. Sometimes it's a little bit difficult because here's our adjustments. Here's our stock. Okay, so really here in the book, here we go. So if a gain results from the disposition of the property, the donee's basis is equal to the donor's basis. If the disposition of the property results in a loss, the donee's basis is equal to the lesser of the donor's basis or the fair market value. Okay, so again, gifts are a little bit more difficult and they take a little while to get the gains. So again, the gain is the donor's basis. Okay, that's our basis. Loss gets to be either or. So it's going to take either the basis in the donor or the fair market value, and it's going to be the lesser of the two. Okay, so if the fair market's less by the date that we receive the gift, we get to take that. If the donor's base is less, we get to take the donor's base. Okay, so yeah, it's a little bit tricky, and again, some of the stuff is hidden in. So you may want to go ahead and always read the chapters. They're not very long and they have tons of examples. So use the examples. Use these. Use the study guides. See, here's our example of a HUD statement. Told you. If you look at a HUD, you can actually see what gets added on and what doesn't for our adjusted. Okay? So there's a lot of stuff that can get added. All this stuff that goes with the taxes, not the loan. Don't deal with the loan, but all these taxes, property tax, owner's insurance, all these are part of our adjusted basis. So again, I love how the book kind of draws out these documents and actually shows it to you. Okay, so again, I would definitely always look at the book. Okay, it's one of the cool little features we've got, especially the online book. Online book makes you able to go from the PowerPoints or the notes and actually look. Okay, so let's start off with this. We're going to do an example that's with the PowerPoint, and it's with loans, or not loans, stocks. So on August 4th, 2018, Juliana, she sold 326 shares of stock in Nanoplasma LLC that she had purchased in 03. Okay, we can already tell this is a long-term one because it's been definitely more than a year when it's from 03 to 18. Her cost basis was $10,000. She sold the shares for $19,000 and paid a commission of $1,300. We need to calculate the amount realized and the realized gain. Okay, so with this, the amount realized is the $19,000 minus $1,300. Again, using our formula up here, this is the amount realized less adjusted basis of property, are basically what it cost us, any extra adjustments we need to make. We paid commission this time around. So 19,000 minus 1,300, that gives us the 17,700. Okay, that's the amount realized. That's how much we actually sold it for. The realized gain is now taken the 10,000 that we have cost in the stock minus the actual amount realized, the sell basically, minus any expenses of what we have. This leads us to an actual gain of 7,700. That's pretty nice. It's a good gain there. I would always like to get an extra 7 grand. Okay. So again, the net capital gains, there's a lot of rules based on it. We really just want to get you the basics of going on. Because again, you're going to have to get through this. I mean, mostly more hands-on than anything. I'll tell you that. Short-term capital gains, again, are taxed at ordinary income rates. Preferred rates are for long-term, and they are reported on a 1099-B. If you're a high income, you also get another 3.8%. It's always not fun. So just like I showed you in the book, here it is in the PowerPoint with the standard deductions that end up happening. So now these are exactly the same rates as qualified dividends. So we've already seen these before. They happen also with long-term gains. Okay. Now so we always want to keep the income levels correct. So always check the income level. Again, if it's a little bit more than 77,200 for married, you're going to actually have tax involved. More for single, 38,600, and head of household, 51,700. Then we have to watch out. We're probably not going to get so high that we'll hit the 20%. But if you do, then that's good. Because, I mean, a lot of people take advantage of these. Okay? That actually helps out a lot. And it did mention the 1099-B. So, let me show you what that looks like in your book. Okay? Going through all this. And here we go. So, this right here is the 1099-B. Okay? And a lot of the ways it is, you're going to see this used in multiple different formats depending on what company it is. Okay? Because Edward Jones has a different 1099B, and the other one that I just went blanked on, but starts with an M, Merrill Lynch. Merrill Lynch also has their own version. So you're going to have to look at these. But they mostly run the same way. They're going to have a description of what the stock was. You're going to have the date acquired and the date sold. So here we can tell it's long term, and they'll even check for us. So they'll say long term gain. And then they're going to tell you if the basis was reported to the IRS. If the basis was reported, the IRS already knows how much you basically bought this stock for. So we bought it for $12,500. We sold it for 18 grand. Okay, and then we had nothing withheld. Again, you can have things withheld. Any income you have, you can have already being withheld, and it's actually pretty good. Okay. And then it's going to show you the Schedule D. So this is our Schedule D right here. And overall, after you've completed and done your list, because you actually do have to make a list of everything and report, you're going to actually report it here on this right here. Okay. So it's cool. A lot of tax software actually uses this to help us out. But with the Schedule D, you're going to have to put in the proceeds and cost basis, and there's going to be a form 8949 that's going to have certain boxes checked. Usually those boxes are checked if the basis is going to the IRS or not, and certain other objects that we will have. We're going to end up having a capital loss or a capital gain. Those affect different. So you want to look at these. This is just the start of passive income. Again, passive income, the definition on its own is income that we did not physically earn. It's just basically handed to us due to things that we're not materially involved with. But of course, here's our short term, here's our long term, and we'll do all of our calculations basically to calculate the gain and loss. Okay. And here's the summary. Again, the summaries are good. They're like extra instructions that tax actually performs. Tells you where to put it. But here's our 8949. So here's A, B, and C. So here's our A, B, and C, our D, E, F, and it's actually going to give you the instructions right here. First off, a lot of it probably will fall into either one of these if we received a 1099-B. One, short-term transactions reported that show basis was reported to the IRS. So if this box is checked, that will be A, and we have to total all the A's together. B, short-term transactions shows that the basis was not reported. Those we actually have to report the basis now. So the IRS wants these all separated. Okay. And then of course C, you have short-term transactions not reported to you from Form 1099-B. This is the sale of property, houses, boats, stuff like that. Again, less than a year. Okay. Same thing with this. We'll have the same items right here. We'll list them out. We'll keep them separate. All my D's, all my E's, and all my F's. So you may have multiple forms of 8949 to keep these grouped together. Because again, you're going to have to total these. Okay? So if all these show basis was reported, I check A, then one list them all out, and then total them at the bottom. Then I'll do another one for everything that was not reported. And another one. This is where software is awesome. I'll tell you that. The software is awesome. And then of course, again, this is qualified dividends and capital gains tax worksheet. This is again something that you want to kind of look over, and it'll actually go down the math process word for word of how to actually do it, which is awesome. IRS really does like to explain as much as they can. Okay. So back to our PowerPoint. Again, tax treatment for short-term capital gains. Short-term capital gains resulting from the sale of capital assets are again held less. Again, the book likes to repeat itself. And this is known as ordinary income and basically taxed at your ordinary rates, or basically what is your tax bracket rate. That's how they take it. So long term, again, we have to basically take our gains minus our losses, and this is our net long-term gain or loss. This is the amount that we get taxed by. Same thing with short term. So this is step one, basically calculating our gain or loss, taking all of our gains minus our losses for long term and short term. Step two, we're going to, if short term and long term net results are the same directions, i.e. both gains or both losses, then we do not net. Okay. If net, but then do not net. If they both are short-term and long-term gain or loss, you can actually do a net capital gain. Okay. I really just say keep them separate. Honestly, it's just better off. Again, short-term does tax at ordinary, long-term taxes its own special way. Okay. So losses themselves, yeah, we can basically total them together. Losses are going to be totaled together. Gains are different, but losses themselves may be taken against any ordinary income up to $3,000 per year. We actually get to take $3,000 per year against our ordinary income, which is basically short term, and some long term as it will be, and all of our gains associated with stock sales. Okay, but we're limited to only $3,000. That's our passive income. Okay, so we don't lose that amount though. If we have a big loss, say $250,000, huge loss there, huge, we get to take $3,000 each year until that loss is done. Okay, so that's indefinitely till forever. Okay, it must maintain nature of capital loss when carrying forward. So in years, we first take care of the short-term capital loss, and then we deal with the long-term. And there is still rules against this. Okay, so when a taxpayer has the net capital loss position, they do have to offset capital gains. And so we take the first 28% in gains. So our net capital loss short term, when it comes into standards, gets to reduce 28% of the gains, then reduce 25% of the gains, then it can reduce regular long-term capital gains. Same thing with long-term capital loss. They take this 28%, 25% rule. Okay, so the best way to show this is more in an example. And the sale of personal capital assets like residence and automobiles, they do not generate a tax deductible loss. Okay, those this only really affects stocks. Okay, personal stuff, no, there is no tax deductible. It has to be held for investment. Okay, and most likely, again, it's still more related to stock sales. So let's do an example right here. Why? Because I can. Chevelle has the following capital gains and losses in her current year. She has a short-term capital loss of $2,000, long-term capital gain of $12,000, and then from prior years, she currently has a carry forward of 7 grand. What is her net capital position if in 2018 her tax implication for capital activities has her adjusted gross income at $42,000? Okay, so she's at $42,000. She's probably going to get taxed 15% already. But let's see what happens. Okay, so step 1, we're going to net our short-term activities. We had 0 gains, but 2,000 in loss. Okay, our carryover comes in handy. It's taking long-term capital gain that we had of 12,000, and we're taking that carryover and subtracting it completely. Gives us a $5,000 gain. Okay. Now, since these are going to 2 separate directions, one, we have a loss in short term, we have a gain in long term right here. We can net these out. Okay. So our long term capital gain right now is only 3 grand. Now, her long term capital gain right now is 0 because she has an adjusted gross income of 42,445. So we'll go with that. So this is per page 4-8. Let's look back at that. I'm going back over it. Something doesn't look right. Let's go 4-8. Okay. Because again, Cengage is not the perfect, but it's taking positive loss income. It's taking this aspect right here. It's definitely not 4-8. I don't know where they got 4-8, because that's a different thing. Because if we look at the tax tables, so because this is all real estate, I love how they do this. Every now and then they just like, oh yeah, we'll do it this way. But even if we look right here, she's doing single, marrying, filing jointly. She has 38,600. Okay, so that's how much she has to beat. She's gonna be times by 15%. Should be 0. She falls under the actual bracket. So right up here, look at this. So if she's falling right in between here, she should have been taxed 15%. I don't know where the PowerPoint is. Our Cengage is saying 0. Doesn't work that way unless she's married and filing jointly. They do not give us that info. Okay, so I'm figuring they are suggesting she is marrying, filing jointly. Okay, because they didn't give us the actual if she's married or not. That would have been something good to actually have to know where she's going to be taxed at. And yeah, because income, so income level, we're using our income level right here. Again, I would suggest that's 15%. The only thing I'm thinking that they're thinking of is that they're taking the cost of goods sold, or I mean the long term, and since it's under 38,600, that's what they're using. And usually tax, the laws have changed so much, and it is funny that way. So let's just go with the book, because most likely in your homework they're going to do the same thing, and we're going to go with that capital loss. So Turber has several transactions going on, and again we're dealing with a couple of bonds, a couple of stocks, and we get the selling price and the capital gain. Okay, so big things is to see if it's short term or long term. All these are long term, and see if he's going to have a carry forward. Okay, first off, we need to find out if there's a gain or a loss. So take your sales price minus your cost basis and we find out. So JetBlue, he has a capital gain. Sales price is more than cost basis. Micron, he actually has a loss. And then in AP Health, he also has a loss. So basically, he has about 6,300 in losses, and we take that from 2,400. He's going to have basically a net long-term capital loss of 2,600. And they're going, since he has both a net short-term and long-term loss, basically he had really no short-term, unless it was actually told here, net short-term loss and 1,700 of net long-term losses, he would carry forward a net long-term capital loss of 900 to 2019. Okay? Their PowerPoint is a little bit off here. Okay? So, it doesn't even give us short-term loss in this example. Alright. Sometimes I either love these examples or they're just really weird. Okay, so they didn't really give us a short-term loss here. And they're saying 17,000 is the net long-term loss that's going on right now. That should have been, feels like a little bit of a gain, but they did subtract the 2,600 from our solution right here of these, and then they take out this 1,700 that we have to deduct because it's a net short-term loss. Okay, and this is because he has both a net short-term and net long-term loss. So the amount that he can actually carry forward is 900. Again, they're probably just giving another example if this scenario had the 1,700, but there's really no 1,700. Okay. So let's jump up to the personal residence. So Cengage loves to throw more examples than what there really is, what's happening. But if you can get to this capital loss, you're good. Okay. The homework in itself does have references and hints and brings out the book itself. Okay. So again, we can take this. This is the awesome little part. This figures out all the income. This lets us know take the smaller of line 1 or line 8. So enter the amount of form of 1040 line 10, which is basically your income, and you just process it through. I would suggest to do this, use this thing as much as when you're capitalizing capital gains, because again, that's just weird of how they look at it, and mistakes happen. So these are not foolproof. Again, I haven't created these PowerPoints. These are coming from Cengage, so every now and then there may be an oops. So, but personal residence, there is rules on this. This is like the best one. So if you have a personal home and you do sell it for a gain, you actually get an exclusion up to 500,000 married and filing jointly, or about 250,000 if it's single. Okay. These exclusions happen for 97 later. Okay. So basically, we're already in this process. So, and it has to be used and owned as a principal residence for 2 of the last 5 years. So in 3 years, in the 5 years, you can have it as rental property. But in 2, it has to be at least 2 of those years you had to live in there and it was your principal home. It has to qualify for that. And believe me, people kind of mess up on this. And again, you can't just keep flipping your personal home, and you have to wait at least 2 years. So you can't do it like every year. Been there, seen people do that, and they get hit with the investment. Okay. Now, This is just something to actually learn of. Sales before 97 were treated differently. Again, you won't see any of these when you process returns because nobody's selling a house before 97. But taxpayers didn't have to recognize the gain or sale of the house if it was bought up when purchasing a new residence. We have to now. Therefore, many taxpayers who sold one or more principal residence over a period of years have a principal residence with a basis that is far lower than the cost of the residence. And these taxpayers get a fresh basis. Okay? They killed basically this loophole. So, a lot when they came out with the new one. And basically it's better off. Unless you really sell your house for over $250K than what you bought it for, you don't have any really problems with it. You don't have to worry about the gain of your house. Okay? In 2009, the loophole came into place of moving into previously rented properties every 2 years and exclude the gain. You're not allowed to do that. Okay? If you rent your residence prior to 2 years of personal use, it's generally limited to a rental property. Okay? It's a lesser exclusion. So basically, live in your house for 2 years, rent it for 3, sell it. That's how it goes. Okay? So, rental income and loss really is part of the taxpayer's gross income. Again, this is a passive item and it's reported on Schedule E. So when we have a loss, it's going to work the same way. We can only deduct $3,000 unless you're actually a real estate professional. If you're a real estate professional, you qualify for that, you can deduct the whole loss. Okay? But there is certain limitations. We're probably going to get into those in just a sec. Okay? Vacation homes, we can use vacation homes. They can both be personal and rental use of residence, but we have to allocate all those expenses. When we're dealing with vacation homes, it's really how many days did you use it personally and how many days did you have it up for rental. A lot of people do this, especially during seasonal and certain times like that. And there is limits based on the period of time residents use for personal versus rental. Gotta be used for more than 15 days as a rental. You can't use it, if you use it more than 15 days as a personal, it's going to limit you a lot. Okay? So, and here it is. Okay? So, there's 3 categories with different tax treatments. Category 1, primary personal use. It's your personal house. If it's rented less than 15 days in the year. Okay? So, it's personal if it's less than 15. Category 2 is known as primarily rental use if it's rented greater than 15 days. Greater or equal to 15. And personal use does not exceed greater of 14 days or basically 10% of the rental days. So as long as you stay under basically 15 days as using it as your personal, take about 2 weeks up there, you're pretty much good to go. And again, 10% of rental days, 365 days if you rent it out for the whole year. 10% is almost 360. So 365, 10% is about 36 days. So you can almost have it for a month of 10%. Didn't exceed that. But it's always a safe bet. If it's going to be like a little vacation home that you're only going to use probably a week or 2, it works. Okay. Category 3, the rental personal dual use, is usually it's still rented greater than 15 days and it exceeds greater of 14 days or 10% rental. Okay, those start getting limited. Okay, they get limited on how much you can tax. Okay, so we're going to look at each of these scenarios and how they work, because rental is actually a pretty cool thing everybody gets into. So first off, primary personal use. It's your personal residence. Rental period is disregarded. Your rental income is not taxable because again, you've only really rented it out for less than 15 days. Mortgage interest and real estate expenses are still reported as itemized deduction. Other expenses and personal are non-deductible. It's your personal home, they don't care. So if you want extra income for 2 weeks, well, you get it. A lot of times this is where Airbnb comes in. Okay? We only rent it during like a peak season, spring break. Okay? When it's with primary rental use, we have all these fun little things. We have to allocate expenses between rental and personal use. So basically, it's your rental days divided by total days used equal rental percentage. Usually, it's 100% if we don't use it at all for our personal. But if we do use any of it as our personal, we have to add that to our total days and divide it from how many days we have it for rental. Okay. Once we have this rental percentage, we're going to take that and times it by all expenses. This will be our rental deductions, and this includes mortgage expenses, depreciation, taxes, tolls, travel, utilities, all that fun stuff. And then you also will have your personal days divided by total days used. This is our personal percentage, and the personal percentage is really only for mortgage interest and real estate taxes, because that gets reported on Schedule A. Personal stuff. If it's all rental, that all gets to be put on Schedule E. And again, if these deductions exceed rental income, they can be deducted against other income, again subject to passive loss rules of that $3,000. Yeah, fun stuff. Okay. So third scenario, if it's the dual, okay, allocate expenses is going to be between rental and personal based on the same allocation formulas as we used before. So it's going to be based on these little formulas. Yay! But rental deductions can be taken up to the amount of rental income only. Okay? So in order as follows, basically we are stuck, our income balance our deductions. We can't take any more, there is no loss. Okay? So taxes and interest can take into a loss situation. Again, that's like our home office that we had in Schedule C. Taxes and interest are automatically get deducted. Okay? So those will go up. Utilities and maintenance are only deductible only up to the remaining rental income after taxes and interest. Depreciation, again, only up to the remaining rental income. So again, we're basically capped at rental income, except when it comes to taxes and interest. Personal percentage, again, it goes on Schedule A. Okay, so the best scenario is just make it completely rental. Okay, so let's take an example, because this usually happens. I have many clients that had ski condos. Okay, so a ski condo in Alta, Utah, and the current year personal use was 25 days and rental use was 50 days. Okay, data pertaining to the rental follows with amounts will be reported on Schedule E and A of the current year. First, we figure out what category it's in and then do allocation schedule. Okay, so we've got 75 days used, but what category do we fall under? Well, we've used it for 25 days of rental use. That's more than 10%. That's right there, more than 14 days. So this is going to fall into probably category 3. Okay. Again, it was rented for more than 15 days, but the personal use is greater of 14 days or 10%. It's greater than both. Okay. So So because rental days was like 5 days if you're looking at 50. So anyway, so this is going to fall under category 3. So personal use, again, 5 days. So it does exceed the greater number, and this is a dual use. So our taxes and interest is $4,500. So when we look at here, it's the addition of these two right here. So these two get added, and so they're added. That's what makes this 4,500. Now it's going to be times by 50 divided by 75. Again, the amount of rented days divided by total days. So 75 days right there. Again, it's easier to do it in this fraction form than actually dividing and finding percentage. But if you like to find the percentage first, you can. So we'll have 3,000 deducted on Schedule E. Okay. So again, now we deal with how much income. So this is our income. So 4,500 is less than 10,000, or 3,000 is less than 10,000. So we still got money that we can use. So we're going to use other expenses. So any other expense related. So utilities, insurance, and snow removal. These right there, we'll put those in blue. Oh, that's a little bit harder to see, but those three right there, those are what makes up the 6,000. And again, times it by 50, divide by 75. Again, we have to separate out the personal. So that's 4,000. We're still kind of good there. Next is depreciation. Depreciation, just they gave us depreciation of 12 grand. Times it by our rate equals to 8 grand. But we're limited because this is dual property. Okay, dual use property with personal and rental. We're limited to the income. Okay, so our 10,000 has already been subtracted first by tax and interest. Then it got subtracted from the other expenses, and depreciation comes at the end. We only have 3 grand left, so we can only take 3 grand of depreciation. Again, that means we basically wiped away our income. Okay? Do we still get carry forward? Yes. Depreciation still carries forward. We can't use the loss, but we get to use it in a later year. That's cool. We actually love that. So we can have a big loss. We're just not allowed to actually put a loss on our tax return. We basically zero it out. The only way that we get a loss is if tax and interest was a lot higher. Okay? So the amount that goes on Schedule A is actually our personal. So easy way, take the total, 4,500 minus what goes to rental, and 1,500 goes to basically Schedule A, which basically stays there and not good use to us anyway, because we probably did beat the standard. But we do get a carry forward, so when we ask, it will be the remainder of probably depreciation. Okay, what we couldn't take. Again, we can't report that on the actual tax return because it's a dual basis. This just gets to be used next year on the income. So our carry forward gets to be used. Okay. So we have another one called the alternative allocation method, and this really requires IRS that uses dual use rental property allocation is based on total days of use. Okay, so that's the IRS. But the tax court has allowed allocations of interest and tax using 365 as the denominator. This allows almost more interest and tax to be deducted on Schedule A, creating greater potential to take other expenses on Schedule E. We can do that. We can just put interest and taxes on Schedule A. More of a deduction because it's $365 all for the rental. This is a very controversial thing. So I would, unless the homework is telling you to do it, this alternate allocation method, I wouldn't touch it, to be honest. I would keep everything the same and just take the carryover loss. Because the IRS and the tax courts are still going round and round. There's no telling who's going to end up coming right on this. So there's going to be fights backwards and forwards. Alright. So, categories of income, there is 3 classifications. And mostly you want to have it inactive as much as possible. This is being involved materiality. So we can have rental income all of a sudden become active. This is what we want to. But sometimes it won't. It's just how it really is generated. Okay? So active income, this is from wages, salaries, and self-employment. This is stuff we're actively in or doing it. Portfolio is basically going to be your dividends and interest income. Okay? Sometimes also your stock sales, but mostly those are going to fall into passive. Okay? And then we have passive, which is basically items subject as limited partnerships and rental real estate. These are your K1s. These are going to have the Schedule E, which I know has popped up on here. So, let me see, because I want to show you the actual Schedule E. And from what it actually shows in the book, because I know I saw it in here, and I want to definitely show you that schedule. Here it is. So here's the Schedule E. Okay, so this is basically the rental portion. So you do have to give the actual physical address. Again, if you have to have any contract labor, you may have to file 1099 MIC. What type of property is it? You can have 3 properties listed on a Schedule E, and you gotta let it know. Is it single family? Is it vacation? Is it just land? Is it royalties, commissions, all that fun stuff? We're not really getting into royalties, but with the residencies you have to know. And then it's going to ask you how many days was it for rent, how many days was it personal, and then we actually go through how much rent received, how much expenses, and then we actually limited ourselves right down here. Okay, but it's always good to actually see these tax documents. Again, if you need to be blown up, you can go to irs.gov like I've done in the previous video and actually see this form as the IRS has done it. It also provides instructions to it. Alright, so passive loss limitations. We do have these. There is certain limitations. Passive loss rules says when taxpayers have minimum or no involvement in an activity generating losses, they are known as passive. Okay, when we have no involvement, they're known as passive, and may not be deducted in excess of passive gains. Okay, losses can be carried forward and deducted in future years against passive gains. So again, any gain that we have in a K1 are actual real estate. They can be deducted when the investment is sold. Okay, when it's sold, we get to lose everything. It's all gone. And they cannot be used to offset active or portfolio income. They're generally not used. Okay, so what are our exceptions? Rental property is designed as passive, even if taxpayer actively manages it. However, individual taxpayers can take up to $25,000 of rental loss, even though considered passive, against ordinary income. That's really cool when we get to do this. This is that real estate property right here. the 25,000 loss capability is reduced by 50 cents for each $1 in AGI that's greater than 100,000. Okay, there's no deductions when it reaches 150K though. Okay, so and rules apply a little bit different. Marrying filing separately, that's who owns it, and usually we're not going to really favor marrying filing separately here. Again, we're in a community property state, so Now, here's our thing that comes up. If taxpayers are heavily involved in real estate, they can be considered as an active business. It's a trade or business. And requirements for this is more than 50% of the personal service that the individual does during the year has to be with real property. And then more than 750 hours of service performed. So if you can hit both of those, you can deduct the entire loss on real estate as a business. Pretty cool, huh? So you have this one where we actively manage. We get 25,000 of rental loss. Here we get the full amount if we're real estate professionals. Okay, so again, if you're actively involved, you get the 25K. Don't get anything above 25K and you are limited. Here, you're not limited. Just got to meet those qualifications. Okay? So, our example right here, Bobby Joe is single and owns a rental duplex that shows a loss of 20K. Her modified AGI before the loss is 118,000. What amount of the rental loss can be claimed? How much could it be claimed in her loss equal to 2,800? So when we look at Bobby Joe, this is how we go. Her modified does exceed 100K. So, and she owns it, but it's highly doubtful if she's actually an active manager. Okay, so since it exceeds 100K, 25 is capped. Okay, so 118 minus 100,000 equals 18,000 excess. So we're going to take 18,000 and times it by 50%, which gives us about 9,000. Subtract that from 25K, it says about 16,000 of rental loss can be deducted. Remember, she's only active. She's not a real estate professional. Okay, so in this case of 2,800 loss, the full 2,800 loss can be deducted. Okay, so if she does have that loss, she's good. Of this loss of 20,000 with her modified, she can only take 16,000. So there's two scenarios right here. So out of this one, she can only take the 16,000, but in the other case, she can take the full amount because it's under 16,000. Okay. So we just have to watch out. It's a lot of math. Net operating losses themselves is designed to provide relief from losses of trade and business, casualty, theft, all that fun stuff. And we do have a couple examples in your book if you want to go look at them. Again, they're showing like 429, but here's our net operating losses. So, and there's a limited right here of 80%, which we're probably going to get into real quick. But on net income deductions, gains and losses must be categorized as either as business or non-business. We do get this NOL. As you saw, it has affected, but we do have a limit. Okay, NOLs generated after 2017 are limited to 80% of current year's taxable income. Prior to that, 100% could have done. There was no need to track separately. But our new law has basically changed that. So 80%. It also stopped us carrying back. Used to be we can carry back 2 years. Now we can't. Now it's just carrying forward till it's done. Okay? The law also said that we limit business losses to 500,000 married filing jointly and 250,000 other. any excess business loss that is not deductible becomes part of NOL. So usually we got a good little thing here. Still got $250K if we can stay under that loss if it's a business. But again, it limits us to 80% of the current year's taxable income. So it also allows sole LLCs, partnerships, and S corps to take the deduction for 20% of QBI. This is our qualified business income. This is our new law that's actually pretty cool. Okay, QBI is net amount of qualified items of income, gains, deductions, and losses related. And we do have outlines. So if we go to our book to right, let's see, right here, these are qualified business income, but it does exclude the following. Can't be any of our capital gains, can't be dividend, can't be interest income, can't be something from a commodity, and any income tax gain deduction or loss of certain national principles and amount received from an annuity, and any item deduction or loss allocable to amount described in any of the preceding items. Okay, so it's got some exclusions, but it's also limited to 20% of taxable income. So we get deduct 20% of our taxable income. Okay, rental real estate may be considered trading business if actively managed. Courts are actually going on about this right now. So that one right now, since this is so new, it's going to have some bugs. Okay, so there is limitations, especially for professionals, but for taxpayers with taxable income above thresholds of $315,000 and $157,500, a phase out starts to occur. For these taxpayers, two additional limitations happen. One, there's a wage limit. If it's greater of 50% of allocable shares of wages from business, or 25% of shares from the wages, plus 2.5 unadjustable base. This is fun stuff. All tangible depreciation property whose depreciation period was not ended in any prior tax year and is used in business, we have a wage limit. Then you have taxpayers whose businesses is being an employee and is a specified service business. We are limited to the taxable income. Again, we get phased out. And this includes any professional, health, law, accounting, performing arts, consulting, and stuff. We get a phase out, and it sucks. So if we're an accountant, if you're going to open your tax firm, you really don't get this if you go over this amount. If you don't, well, you get the full amount. So to calculate the phase out, first you gotta determine the wage limit. So excess of QBI deducted with no limit is greater than QBI deduction with limit, is known as example excess amount. So that's one thing. Then we got this is subject to prorate, pro phase out based on taxpayer overall income. So again, this can be really complex for multiple businesses. So if we look for example 439, let's see. Here's the limitation. Here's an example right here. I mean, you want to kind of look at these examples as they go on. Here's our wage limit. Okay, so there's a lot of fun stuff. This one does go about how our wage limit is, and here's a good one. So qualifies for the QBI, and all of a sudden he has wage limit. Josh has purchased a place in service, 5-year recovery period. So there's a lot of fun. I mean, this one can go through a lot of stuff. We really just want to know the overall aspects of what's going on and keep the limitations where they're at. This is where I provide another video that kind of goes over how tax person gets limited. Again, so that's it for this chapter. Hopefully this helped y'all out just a little bit more. And if you got questions or you want me to further explain, dive deeper in, just leave me a comment and I will do that. Besides that, that's it for this part of taxes. Again, that QBI is something that's really new and it's going to take a few years for it to get hammered out completely. So if you have any questions, let me know. If not, it's all good. So this ends the next exciting chapter of taxes with Professor Naragon. Okay? Y'all have a good one, and I'll see y'all later.